The chairman of the Fed, Jerome Powell, is in the process of testifying in front of Congress on inflation, jobs, and the economy. And this is fascinating because the most recent inflation report that just came out yesterday shows record inflation at its highest rates in well over a decade. And this is a problem that negatively affects everyone. It affects investors and it affects the poorest of poor individuals. So lucky for us, the day after this report came out, showing 0.9% monthly increases in CPI and 5.4% annual CPI inflation, nearly triple the target in normal times, Jerome Powell is testifying, and that's what I'm going to break down here. That way you have everything you need to know and you don't need to sit through a multiple hour long testimony. So typically these testimonies are terrible. But I actually need to hand it to the representatives that I've seen so far. They've asked quite good questions. They seem to know the questions to ask, and they're digging in here. So I actually really appreciate this testimony. I got to give them a little bit of a hand. So I'm going to summarize how the Fed is reacting to these numbers. Then we know what to expect and if this should affect our investments or our decision making, or if our dollar is just going to continue to shrink and shrink and shrink. So the overarching issues discussed today are the following. First, the jobs problem. There's not enough workers. 60% of companies have increased wages to help attract employees, and it's not really working. Second, 47% of small businesses have increased their prices, and inflation is here. We can see this with the CPI data. It's hard to argue that there isn't some kind of inflation. You could argue that CPI isn't perfect. There's a lot of ways you can piece apart CPI and say, like, this doesn't make sense, but it's hard to argue that prices aren't increasing, and unemployment is high despite massive action by the Fed. So that's the three major issues that we're seeing discussed in this testimony. So the testimony started off with some opening remarks, and then Jerome Powell, had some remarks to start things off. So just to summarize the Fed's goals. So they have two main goals: to maximize employment and maximize price stability. Those two things. We need to remember that focus when we talk about how he answers questions. So he started off by saying that we've seen strong growth in the economy, which of course is good. GDP is increasing the fastest in decades, which makes sense with how much money is being pumped into the economy. He says that supply constraints are lowering, supply mainly in industries that need semiconductors like autos and, some effects in real estate. The labor market has improved, but there's a long ways to go. The unemployment rate is still 5.9%, and we really want that around like 3.5%. Inflation will remain elevated for the coming months, he says, and the areas with supply constraints and increase in prices should partially reverse. So he feels that like areas with autos, or areas like autos who have this issue with semiconductors, are seeing these massive increases in prices, but he feels those prices are going to reverse after supply issues come undone. Now, you could easily argue the other way around, that once these prices increase, why would they lower the prices? This is just what he is commenting on this situation. And he still believes that inflation will remain around 2% in the long run, despite these big spikes that we're seeing right now. So got into the questions, and I'm just going to summarize some of the better questions, the more material questions. So first one that I thought was worth addressing is what's going on with housing prices. And he said that housing prices, which that's kind of out of their area of focus, is mostly due to material shortages and migration into suburbs. Basically, people moving from dense metro areas and going to single family homes, and there's just not being enough supply and not enough supplies to build these homes. Of course, low interest rates pushes that up as well, but he doesn't believe that that's the main driver. Again, you could argue that either way and point a million different reasons how interest rates are a main driver there. Next question, will adding 4.5 trillion in spending through the most recent Biden bill proposal affect the Fed's decision making? Do they take in that criteria, the spending that isn't their decision, do they take that in on their decision making? He said, yes, that's one factor of many. However, he didn't give any context like how exactly they would change their decision making if that Biden proposal, the infrastructure bill, got passed, because he said it would really where it's spent really matters as to how they would react to that. And I will say, a lot of his answers are not very specific. He can't give specifics. He says, I have to talk to the committee. I don't know the answer to this. So I'm explaining what we do know based on what he said. There were some interesting points made about central bank digital currencies, basically the US government making stable coins and other cryptocurrencies, and there were some good questions on that, surprisingly. They were wondering when the white paper is coming from the Fed on a central bank digital currency, and that is coming sometime in September. They also talked about Tether and the concerns there of it not being backed as a stable coin. And basically Jerome Powell said, yeah, we're concerned, and this is something that should be regulated like any other market. And the Fed is also, like I said, looking into stable coins, cryptos, and CBDCs, which is the central bank digital currencies. So that's really interesting that they're really kind of going head first into this and seeing if this is something that makes sense. Also, we have a lot on the Fed asset purchases, which we're really going to break down because it's a fairly complicated subject, but I think we can make it more coherent. So right now they're purchasing $120 billion a month in mostly federal-backed securities. And there was a few questions here, quite a few actually. So they're asking, why is this continuing? And why do you say this is going to continue until substantial further progress happens? And what does substantial further progress even mean? Part of the issue with the Fed is they don't give specific guidelines as to when they're going to change things. So they say things like substantial further progress or until things get significantly better. And there's a lot of questions like, what is that? What can we expect? And they never give any numbers or what exactly they're looking for. But we do know that as of right now, the Fed is purchasing $120 billion a month in assets. Now, I wanted to break down what that really means because we hear about this all the time and it's not explained very well, I feel like. So let's break this down. I'm going to go over to the iPad here and do a little presentation on what exactly this works. Or how this works. So this is a normal market. You have buyers and you have sellers. Typically, they're not the same person. And in this theoretical market, the money is all within itself. I know there's a lot of outside influences, but we're just going to keep it simple here. So in this market, the money supply is constant. So there's buyers and sellers. The total amount of money in that market is always the same, theoretically. And then we have asset purchasing from the Fed. And this is when you hear the words quantitative easing, that's what this is. Now, quantitative easing sounds like a word that you hear and you're like, you know what, that probably is so complicated that I'm not even going to Google it. Well, this is what quantitative easing is. It's kind of a strange process that hasn't been going on that long. It's kind of like a monetary experiment, if you will. So here's how it works. We have the same market, buyers and sellers, but what happens here is the Fed also becomes a buyer of mostly federal-backed securities. Now, what this does is it puts far more money into the markets, into the economy, because they're creating money that didn't exist before. So this adds money to the money supply because they're buying assets. They're buying assets with money that they create. So they're creating money, buying assets, adds to the total money supply. And this does a lot of things, including propping up markets. So they're doing $120 billion of buying per month, which is monumental amounts of money. I actually have a chart here on the other screen that we can take a look at. So on this screen, we can see this is the amount of assets that the Fed holds. This is their balance sheet. We can see that they did a lot of purchasing, coming up to 2014. This was after the 2008 financial crisis. And then it actually started decreasing. Basically, their assets started expiring. They typically don't sell assets. And then we can see in 2020, 2021, we can see this really jump up. And that's the quantitative easing. This is the $120 billion per month in assets that we're seeing purchased. So they're adding money to the money supply, but what exactly does this do? And this is a few things that it does. First off, more liquidity. It gives banks more liquidity. There's just more money circulating around. Theoretically, a larger GDP, because if you look at GDP, this is the money supply, which is being increased from the Fed, pumping more money into the economy. The money supply times the velocity of money equals the GDP. So theoretically, the GDP goes up when they increase the money supply. Lower value of the dollar. If the dollar is worth $1, if you have 100 of $1 bills, you add 10, each dollar is theoretically worth less than before you add that 10. If you're looking at the value as a whole. And then it pumps up the economy. So that's what quantitative easing is. And a brief rundown of what exactly quantitative easing is. If you enjoy that, just make sure you like this video, subscribe, do all the things if you appreciate me breaking down that kind of stuff on the iPad. So jumping back into the questions, of course, there was tons of questions on inflation. Basically, what exactly is going on with inflation? Is this because of the Fed policy? Is this because of the Biden administration policy? Of course, he said he can't comment on that. But he did say, and this was kind of surprising to me, that inflation data is higher than expected. I was really surprised to hear that he was like, this is a bit more than expected. He didn't linger on that point. So he said it was higher than expected, but on track. So that part didn't exactly make sense to me. And he feels that we're being disproportionately affected from a few categories like autos, which of course autos are definitely propping it up. But one could argue that something like home prices aren't factored in properly, so that's actually weighing down the CPI. Of course, the CPI, again, is not perfect, so you got to take the exact figures with a grain of salt. Now, next question he was asked is, what level of inflation will we need to hit before some kind of intervention is made, before interest rates go up, before you lower these asset purchases? What needs to happen? And this is where we get some more very general, not specific guidelines. And he basically said if inflation remains materially high for a long time, they will change policy. And the rebuttal here was, what's materially high? And he was like, we're not sure exactly. This is something that the committee will address and have to discuss, and then we'll have to go from there. So as of right now, he basically is saying nothing changes. This doesn't change anything. Interest rates are going to remain right around zero for the foreseeable future, as long as we have high unemployment. It's basically going to be this is the way it is. $120 billion per month in purchasing, low interest rates until we can figure out this unemployment nut. And the question, of course, is why is unemployment so high? If you're spending so much, why isn't this helping? And a great question that was asked is, do you think that we're jeopardizing long-term health for some small short-term gains? He was asked, do you think we would see the same amount of improvement in unemployment if you were spending $60 billion a month instead of $120 billion a month? And he said, we're not really sure exactly, but they feel that $120 billion is the correct number for this situation. So it's a difficult situation because, again, the Fed's goals are to decrease unemployment as much as possible. They wanted that right around 3.5%, where we were in 2018. And he said, that took nearly a decade to get to that level, and it's going to take a while to get there again. So that's one of their goals. And then price stability, which arguably, I don't know if they're doing the greatest job of, but they're saying that this is a short-term spike in inflation. But again, there's a lot of unknowns here, and they even say we don't know exactly what's going to happen, and this is higher than we expect. So it's a little bit scary from my point of view, but that's really the gist of this testimony. I hope that this was helpful and illuminating as to how monetary policy is going to react or is reacting to this crazy report that we received. And basically everything's staying the same as of right now, and stocks will likely continue on their trajectory until some kind of change is made in this market. Home prices will stay high until there's some kind of change in interest rates, and that's kind of where we're at. So I'd like to thank you for watching, and I hope you have a profitable day.